All right, let's dive in. Today, we're tackling one of the biggest moves in the business world: how you buy a publicly listed company in Saudi Arabia. This is a super high-stakes game, and there's a very specific rulebook designed to make sure it's played fairly.
I mean, think about it. It's a massive question, right? When you have billions of dollars and the entire future of a company on the line, you can't just make it up as you go. Without some clear rules, it would be total chaos. So how do you make sure a deal is transparent and that every single investor, from a giant fund down to a person with just a few shares, gets a fair shake?
Well, that's where the referee steps in. In Saudi Arabia, that's the Capital Markets Authority, or CMA for short. It's their job to set the rules of the game and enforce them, all to create a market that's stable, predictable, and most importantly, trustworthy for everybody.
And this quote right here, it's not just some stuffy legal text. This is the core philosophy, the absolute heart of the entire system. It means that whether you own 1,000,000 shares or just one, the buyer has to treat you and your investment exactly the same. It's all about creating a level playing field right from the start.
So, how does a deal actually get done? Well, the regulations lay out two very different paths an acquirer can take. You can either try to hash out a deal behind closed doors, in private, or you can make your offer public for the whole world to see. Let's break down both of those.
And there's a huge difference in the approach here. On one side, you got the private transaction. Think of it like a quiet backroom negotiation. It's all about secrecy. Then, on the other side, you've got the public offer, which is the complete opposite. It's totally transparent, highly regulated, and it all unfolds in the public eye on a very strict schedule.
Okay, let's start with path number one. Imagine you want to buy a massive stake in a company, but you don't want to cause a market frenzy that just drives the price through the roof. You'd probably choose the private deal, which, as you can see, is governed by some very, very strict rules about secrecy.
And when we say confidentiality, it's not just a friendly suggestion, it's a hard requirement. All the discussions have to be kept under lock and key. Information is on a strict need-to-know basis. The whole point is to protect the market's integrity by preventing leaks that could pump up the stock price or, even worse, lead to illegal insider trading.
But you know how it is. Secrets have a way of getting out, right? So the system has a built-in tripwire. What happens if, despite all the precautions, rumors start flying and the market starts reacting? What could possibly force a secret deal out into the open?
And here's the answer. The regulations have these very specific numerical triggers. If rumors cause the stock to jump 10% in a single day or 20% since the talks first began, well, the secrecy is over. At that point, the parties are forced to make a public announcement, and what was once a private deal is now public news.
All right, let's switch gears and look at the second path, the public offer. This is the much more formal, structured route where everything, and I mean everything, happens according to a very precise, pre-approved schedule.
This timeline really gives you a feel for the journey. It kicks off with a public announcement. Then, within about a month, every shareholder gets the official offer document with all the details. After that, there's a window for the buyer to sweeten the deal, or for a rival company to jump in with a competing bid. By day 60, if enough shareholders say yes, the offer becomes unconditional. It's officially locked in. Then, the deal gets settled and everyone gets paid. It's an orderly, step-by-step process designed for complete clarity.
Now this is where it gets really interesting. In any deal, the more of a company you buy, the more the rules change. As your ownership stake gets bigger, you start crossing these critical thresholds that trigger major new responsibilities. The stakes get higher, and so does the level of scrutiny.
First major line in the sand is at 40%. Once you own this much, the regulations basically say you're no longer just an investor, you're now a serious suitor. At this point, you are required to publicly announce your exact plans for the company's future, what you're going to do with the business, its strategy, and very importantly, what's going to happen to its employees. It's a huge step toward transparency. But 40% is just the warm-up. The real point of no return is at 50%. This is, without a doubt, the single most important threshold in the entire rulebook. Crossing this line triggers a rule that is absolutely fundamental to that whole principle of fairness we talked about at the beginning. It's called the mandatory offer. And what it means is that the second you gain control of a company by buying 50% of its voting shares, you are legally required to make an offer to buy out every single one of the remaining shareholders. You can't just take control and leave everyone else behind.
So here's how it protects the smaller investors. As soon as a buyer hits that 50% mark, the mandatory offer kicks in. But here's the real key.
The price they have to offer you must be at least as high as the highest price they paid anyone for a share in the last year. This rule is a powerful protection. It ensures that minority shareholders get a fair price to exit and aren't stuck selling for less down the road.
Okay, so the offer has been accepted. The buyer is in control. What are the final steps to actually merge the two companies into one?
Well, the regulations lay out two main ways to do it. The first is an absorption. That's where Company A buys Company B, and Company B is just sort of folded into Company A and disappears. The second is a formation, where Company A and Company B merge to create a brand new company, Company C, and both of the original companies cease to exist.
Now, finalizing the deal also means clearing two different approval hurdles. First, for the offer to even succeed, it needs a thumbs up from shareholders who own over 50% of the company. But to finalize the actual merger, the legal combination of the companies, there's a separate vote, and for that the bar is much higher. You need a 75% approval from shareholders.
And to keep everything fair, the rules also stop the board of the company being acquired from trying to block the deal unfairly. These are called frustrating actions. For example, without getting approval from their own shareholders, they can't just issue a ton of new shares to water down the buyer's stake, or sell off the company's crown jewels, or get into some weird contract just to make the company less attractive.
So when you boil it all down, from the secret deals to the public timetables and these mandatory offers, everything we've looked at really rests on these three pillars. Fairness, to make sure everyone's treated equally, transparency, so all the important information is out in the open, and order, to provide a clear, predictable process for every single deal.
And that right there is the ultimate goal. The reason for all these rules is to create a market that's real, stable, and rational. It's about stopping artificial price swings and making sure that business can be done in a reliable environment, which, at the end of the day, is good for the whole economy.
And that leaves us with a final thought. This rulebook provides a really solid foundation for a modern capital market. So as Saudi Arabia's economy continues to open up and bring in global investment, the big question is, how will these rules for fairness and transparency shape the next wave of mega deals and the future of business across the entire region?